Welcome to Trading with Rich. This is a quick overview of what I do and why I do it and how I do it. I'm going to walk through some of the basic philosophy of selling options, buying stocks, buying leaps, and doing covered calls on those and setting up puts so that we can make money while the market is going up, which is a bull market, or while the market is going down, which is a bear market. We can make money whether the market is going up or down, and we can do it with different levels of risk. So, first of all, are you ready to make 15, 25, 40% annually? In the history of the stock market, it has historically returned an average of 10% annually. Some people will say 8%, some people say 10%, but that's before inflation. It's 8 to 10% over the last 90 years. However, the stock market returns vary greatly year to year and rarely fall into that average. As a matter of fact, over the last 20 years, the annual return on the DJI has been between 8 and 10% only 4 times in the last 20 years. So are you ready to make 15, 25, 40 and double what the actual market does each and every year? Well, first of all, know and understand the golden rule of 72. Take your earned percentage and divide it into 72. That's how long it will take you to double your money. So the example, I've got $50,000 invested and I'm earning 15% each and every year for the next 5 years. I can double my investment and get it to $100,000 if I earn 15% each of those years over 5 years. Now, if I earn 25%, you'll double your investment in less than 3 years. So it'll go from 50 to 100 in 3 years. Now, 40%, we will double in less than 2 years. So the results of 50,000 earning 25% a year will be $400,000 in 9 years. That's why you're here. That's why you're listening to me. You're not satisfied with mutual funds. You're not satisfied with the brokers that are giving you 4 to 6% every year. And you really want to try to catch up for lost time. The stock market. How different is it today than what it was back in 1930s? Is it similar today in 2020? Well, from the mid-1920s to the late 20s, the U.S. stock market expanded rapidly. Does that sound familiar? Sure. This expansion continued for 6 months after President Herbert Hoover took office in January 1929. The prices rose so high that many call it the Hoover bull market. Any and everyone from all walks of life were rushing to brokers to invest any money they had in the stock market. They thought they could sell these securities for a hefty profit. Does that sound familiar? Do you realize that we had a bull market for about the last 12 years? Many people even mortgaged their homes to raise money to invest in the stock market. So what happened? Well, financial historians usually blame the crash of the U.S. stock market on October 29th in 1929 for the start of the Great Depression. But there is a second side to this. On the other side of the coin, there are others who do not agree with this analysis and believe that the stock market crash was the result of the Depression and not the cause for starting the Great Depression. So my theory on stocks and handling options, buying leaps and all that is we will react to the market. We have no idea which way it's going to go, bull or bear, whether it's going to go up or it's going to go down. And in today's market, there are over 1 billion shares being traded daily. To give you some perspective on that, back in the summer of 1929, before the crash, around 300 million shares were bought and sold over the 90 days. So 300 million over 90 days. Now there's over 1 billion. 1 billion is 1,000 million. So 3 times more shares being traded daily than what there was for the whole summer of 1929. So even back then, the financial leaders, President Hoover and then Treasury Secretary Andrew Melton, tried to assure business and all other people that everything was fine and economic prosperity would soon prevail. Isn't it odd that some things never change? No matter which administration is currently in power, you have to understand the philosophy of fear and greed while investing. So, although in the early part of 1930 the market did recover, I heard that before, right? Oh, we've had a great recovery today. By May 1930, the panic set in again. It would be another 20 years before the Dow Jones Industrial Average could regain some semblance of normality. So we're in that type of market again today. And some of you may have lost a lot of money in your mutual fund. Some of us, lost 35% in March of 2020 and have gained a little bit back. And then we are starting to go back down again. How do we keep our money intact but still stay in the market and take advantage of the gains that are happening? So I actually have a strategy to do that. And basically what I do is I do covered calls, puts with stock, leaps, and options. And I understand that some people have different tolerance for risk. So I have what I call the Saver Club, and then I have the Growth Club, and I have the Aggressive Club. And those can be 10% or greater, 20% or greater, or 30% or greater. The important thing is to know your businesses. Let's invest in stocks that you know something about. Something that you'd love to research, but you'd like for me to go ahead and execute the trades. Something you'd like to own for 3 to 5 years, which doesn't mean you necessarily own it and never sell it. You're going to work it weekly for 3 to 5 years. But we have to understand the greed and fear, share those type of thoughts with each other so that we can actually make some good decisions and go forward with confidence. We have to watch out for that fake news, the tweets, and the FOMO, fear of missing out. The important thing about the strategy is the extrinsic and intrinsic value of the options. Evaporation is every Friday at 3 o'clock. I will talk with you through our research clubs about what evaporation means, the extrinsic and intrinsic, but really it's a key part of the strategy. The other key part of the strategy is closing and rolling, doing your exit strategies, understanding when it's time to get out of something, and sometimes it's just time to let it roll and keep collecting the profits. Understanding volatility and understanding that diversification is the byproduct of fear of losing. We are not going to invest in every single stock. If we want to do that, we just do an index fund for the S&P 500, or we do an index fund for the Dow Jones Industrial and spread our stock over every stock in America. That would be being average, and this club is not about being average. This is a financial club where we actually invest and work the product, and here's how we're going to do it. So what is a covered call? A covered call is where you agree to sell your stock for a future price on a predetermined date. It's like renting your stock out. You collect your rent weekly, you keep the condo until it's hit its peak, maybe you sell the condo and rebuy it later. But the key is, at the moment, you're leasing to own. You agree to sell it if the price is met on a future date that you picked. You earn a premium from the buyer to give them the right but not the obligation to buy your stock in the future. So if the condo is $200,000 and you're renting it out for $2,000 a month, you agree that you'll sell it to that person for $250,000 2 years from now. In the meantime, they're going to pay you a premium for the right to be able to buy that condo for $250,000. Now, they're kind of hoping it'll go to $300,000 and they get a good deal in a few years from now. That's what this is all about. Covering your equity. So, the basic strategy has a few kind of key principles to it. Picking a profitable stock is a 50-50 proposition. There are no guarantees, no crystal balls. You have to do your due diligence and research your companies. Pick stocks that you're prepared to own for 3 to 5 years. We're going to work them weekly. We're going to buy the stocks, buy the leaps, and we're going to sell options such as covered calls, insured puts, strangles, vertical spreads, iron condors, butterflies, all those type of things I will do inside the portfolios to try to hit the different percentages, whether it's 15, 25, 40. That'll be based on how far we put our strikes, how far we put our dates. I'll incorporate all that into what your risk tolerance is. We don't buy options. We don't bet on direction. We react to the market. We work with companies that I understand. So I have about 80 stocks in my watch list, and I'm using about anywhere from 6 to 12, depending on how much money is that particular portfolio. And I may use 6 stocks one week, and I may use 10 stocks the next week. But I understand those. I do not chase companies that I have no idea what they're doing, and I have no idea where I believe their trends are heading. So this is not day trading. This is not a get-rich-quick scheme. Calls were invented back in 1972, and puts were finalized in 1988. It's been going on a long time. There's a big question out there as to why people don't understand option trading, especially selling options and being the bank. But it's been going on for a lot of years. It's not something that I invented last week. I just have become very good at it, and I'm hoping to share it with you. So the idea is to collect premiums on Friday and work hard not to pay it back. So my watch list, this is my watch list right here. We create a watch list of the best stocks, and then we stock the shelves with great company stocks. Then we select the option that we want to sell. We either do a call or a put. Basically, everything revolves around doing a call or a put. And then we pick the target price and the expiration date. Now that's where the risk tolerance comes in. We manage our positions daily. We sell premiums on Monday and Friday. We adjust Tuesday and Wednesday and Thursday. And we research all 7 days. Always have your ear to the radio. Always watch YouTubes. Always do a lot of reading and research, so that you're confident about the companies you're working with. So what are extra strategies? Well, you can roll the position, or you can hit a double, or you can go ahead and just let it expire and close the position. And that's another exit strategy. All those types of things I do every day. So in the end, we just rinse and repeat. Every week we do it, close everything out, roll it or close it, and then we rinse and repeat. So part of the advantage of being in this club is that you get free membership with the Trading with Rich membership club, which is normally $9.99 a month. And when you go in there, go into the library, and you can go ahead and click on the online courses, and you can learn how to do this, or maybe understand better what I'm doing for you. And you can follow your online courses through the mobile Kajabi app. And I've also got a YouTube channel called Trading with Rich, where we do podcasts and share a lot of videos. So what are some of the keys? I'll finish with just a couple points. 1, keep track of your return on capital. Superstars keep score. You got to know what your return on investment is, and we're really shooting for some super high goals here. 2, analyze your fundamentals. I will track sales, price to earning variables, debt and cash flow. I'll read K9s on those companies. That's another reason why I only follow about 80 of them and use 6 to 10, because that's a lot of work, and you can't do that on thousands of stocks. Trends and momentum. Know the short-term and long-term price expectations. Use some common sense. Know the management. Short-term or long-term culture. You're going to own this for a long time. You want to be a part of this business. You want to be a part of their culture. So, as I said, in closing, we have a Trading with Rich membership club where you can ask questions and I'll respond to them. You're always willing and able to text me or email me. You can follow your courses online on the mobile Kajabi app, and you can follow along with our club here on the Trading with Rich YouTube channel. So, hope you enjoyed the presentation. I tried to keep it as short and sweet as I possibly could. Have a great day.